One Big Beautiful Bill enacted a new federal tax provision that allows eligible tipped employees to deduct up to $25,000 in reported tip income on their personal tax return without changing employer payroll responsibilities. Most Texas business owners have heard the phrase, "no tax on tips," but very few have received a clear explanation of what it actually means. Today, we're going to break it down from an employer's perspective, how it's administered, what changes and what doesn't, how it affects payroll and compliance, and what you should be telling your employees so expectations are set correctly. The first and most important thing to understand is that no tax on tips does not mean tips are completely tax-free. This provision creates a federal income tax deduction, allowing eligible employees to deduct up to $25,000 of reported tips when they file their tax return. It does not eliminate reporting requirements, and it does not remove payroll taxes. This distinction is critical for compliance and for employee communication. From the employer side, this law does not change core payroll responsibilities. Employees must still report tips. Employers must still include reported tips on W-2s. Social Security and Medicare taxes still apply in full. If you're using the tip credit under the Fair Labor Standards Act, those rules remain unchanged, so operationally, payroll continues exactly as it does today. The real change happens at the employee's personal tax return, not in payroll. Eligible employees can deduct qualified tip income, which may reduce the amount of federal income tax they owe or increase their refund. This benefit is not reflected in weekly or bi-weekly paychecks. It shows up when they file their taxes. There are also income thresholds, so not every employee will qualify. Only voluntary tips determined by the customer qualify. Automatic gratuities or mandatory service charges, even if they look like tips, typically do not qualify. Cash tips and card tips count only if they are properly reported. Unreported income cannot be deducted. This reinforces the importance of accurate tip reporting for both the employee and the employer. Some employees may assume this means they don't need to report tips anymore. That is incorrect. Others may actually be more willing to report tips now, knowing there's a tax benefit at filing time. As an employer, you want to stay neutral, factual, and consistent, explaining the rules without giving tax advice. Here's a simple, compliant way to explain this to employees. Tips are still income and still need to be reported. Nothing changes on your paycheck or W-2. The new law may help you at tax filing time by reducing your federal income tax, but payroll taxes still apply. For personal tax advice, you should talk to a tax professional. This keeps expectations realistic and protects your business. For employers, there is no reduction in payroll tax liability and no increase in wage obligations tied to this law. The biggest financial risk comes from misunderstandings, disputes over pay, reporting errors, or incorrect assumptions. Clear communication and accurate payroll processing protect both your business and your employees. As this provision rolls out, the IRS will be paying close attention to how tips are reported. Texas businesses in hospitality and service industries already face scrutiny. Clean payroll records and clear documentation are your strongest defense. This is where having the right HR and payroll partner becomes critical. The no tax on tips provision doesn't have to be confusing or risky. With affiliated HR and payroll, Texas business owners can stay compliant, communicate clearly with employees, and confidently navigate these new rules while focusing on running their business.